You've been in that moment before. Your trade is on, the market twitches, and suddenly your pulse spikes like you're strapped into a roller coaster you didn't sign up for. You tell yourself you're calm, you've prepared, but your mind races. Should I exit now? Double down? Is this the reversal? That pressure, that surge of emotion, isn't just adrenaline, it's bias under stress. Max Bazerman and Don Moore argue in Judgment in Managerial Decision Making that when the heat rises, your brain doesn't just malfunction, it rewires your perception of reality. You think you're making a rational choice, but really you're filtering the market through the warped lens of stress. Bias isn't abstract. It's the red candle that forces your hand, the green breakout that blinds you to risk. When stress hits, your decision making narrows, your perception of probability warps, and your time horizon collapses to the next tick. You're not analyzing anymore. You're reacting. Behavioral economists call it bounded rationality. In theory, you weigh all available information and act optimally. In practice, you use shortcuts. Stress makes those shortcuts more seductive. Kahneman and Tversky showed it decades ago. When uncertainty spikes, your brain clings to heuristics, rules of thumb that feel safe, but often mislead. Think about anchoring under stress. The first price you see, say $150 for NVDA, becomes the yardstick. Even if new data screams revalue, your brain clings to that anchor, especially when stress narrows your focus. Or availability bias. The last big loss floods your memory, so when a similar chart appears, you overestimate the likelihood of disaster. Stress makes recent memories louder than rational probabilities. That's why after one violent stopout, you hesitate to take the next setup, even if it's valid. You're not calculating, you're remembering pain. Trading stress is unique. Unlike most managers in Bazerman's examples, you're punished in real time with visible P&L swings. A CEO might wait quarters to see results. You see it tick by tick. This immediacy magnifies stress and makes bias unavoidable unless you recognize it. That's why Mark Douglas in Trading in the Zone insists discipline isn't about being emotionless. It's about creating a mindset that filters noise. He echoes Bazerman. Under stress, your judgment will bend unless you pre-commit to rules that hold you steady. Here's the wake-up call. Have you ever broken your trading plan because of a red candle? That was stress bias. You thought you were making a rational adjustment, but really you were succumbing to fight or flight. This matters because stress is not rare in trading. It's the default. Every trade carries risk, uncertainty, and potential regret. So your question isn't whether bias shows up, but how you prepare to handle it. Bazerman and Moore's research shows that stress compresses your cognitive bandwidth. You literally can't see the full picture. That's why elite traders simplify their playbook. Fewer setups, tighter routines, cleaner risk parameters. They aren't simplifying because they're lazy. They're building decision structures that resist stress distortion. Brett Steenbarger reinforces this. The best traders automate the boring stuff, so when stress spikes, their limited bandwidth can focus on the one decision that matters. Stress bias also explains why traders chase. After a missed entry, stress triggers loss aversion. You feel you've already lost an opportunity, so you rush into a worse entry just to soothe the pain. But as Bazerman points out, these compensatory moves usually backfire because they're motivated by emotion, not logic. That's where Jared Tendler's work on mental game comes in. He teaches traders to label emotions in real time. This is stress, not insight. So you can separate feeling from fact. Try it next time you feel that itch to make back what you missed. You need to treat stress like an opponent, not an excuse. The market doesn't forgive stress mistakes. Whether you're fatigued, over-leveraged, or distracted, your P&L doesn't care. Bazerman's research shows even seasoned managers regress to bias under pressure. So don't kid yourself that experience alone protects you. You must build pre-commitments, written rules, position sizing, stop-loss automation. When stress blinds you, those systems keep you safe. Think of them as your autopilot when turbulence hits. So ask yourself, where does stress bias hit you hardest? Is it exits? Cutting winners too fast because you fear reversal? Is it entries, hesitating until the setup is gone? Or is it risk, doubling down when you should be cutting? Each trader has a weak point. Bazerman's work says the solution isn't to eliminate bias. You can't. The solution is to predict when it hits and design guardrails. For traders, that means journaling stress patterns, noticing when your pulse climbs, and rehearsing responses. This is how you turn bias from an invisible saboteur into a manageable factor. Because here's the truth: stress isn't leaving. If you want a career in trading, you don't wait for calm seas. You master the storm. You don't say, I'll stop being biased. You say, I'll catch my bias before it catches me. Bazerman and Moore give you the science. Douglas, Steenbarger, and Tendler give you the tools. Your job is to weld them into a shield strong enough to survive the chaos. And every red candle you face is a test. Do you bend or do you hold your line? You've seen by now that bias isn't going away. Overconfidence, anchoring, confirmation, escalation, framing, fairness, they're baked into human judgment. Bazerman and Moore don't pretend you can erase them. Instead, they show you how to design systems that reduce bias, creating structure strong enough to keep you rational under pressure. For traders, this is the ultimate edge: not predicting markets, but designing defenses against yourself. System design starts with rules. Simple, written, non-negotiable rules. You can't expect to outthink your emotions in the heat of a trade. You need a framework that catches you before bias takes over. Bazerman emphasizes checklists. Airline pilots use them, surgeons use them, and traders should too. Checklists reduce reliance on memory, which bias easily corrupts. Your pre-trade checklist might include trend context, risk size, stop location, target, emotional state. If you can't tick all boxes, you don't trade. That's how you turn discipline from a vague intention into a concrete system. Another tool is automation. Bazerman and Moore note that structured decision aids, like algorithms, cut bias by removing human whim. For traders, this means stop-loss automation, bracket orders, and even algorithmic execution. Every time you let software enforce discipline, you shrink bias's grip. The trader who says, I'll close it manually, often never does. The trader who automates exits survives. Jared Tendler teaches traders to rehearse responses to common triggers. You know you'll feel stress, FOMO, tilt. So you rehearse. When I feel X, I do Y. That rehearsal is systemization of emotion management. Brett Steenbarger adds, embed routines, morning prep, midday breaks, evening reviews. Routines anchor you when chaos hits, so bias has less room to grow. Risk systems are the backbone. Position sizing formulas, max drawdown limits, daily stopouts. These aren't restrictions, they're protections. Bazerman shows that when decision makers predefine limits, they resist escalation. Traders must do the same. Without limits, you're prey to bias. With them, you're shielded. Consider Mark Douglas again. Your job is not to predict. Your job is to execute. Systems turn that philosophy into reality. You don't need to guess the next candle. You just need to execute your rules consistently. Systems make trading boring, and boring is profitable. Bazerman and Moore also highlight the power of external review. In organizations, accountability partners reduce bias. In trading, mentors, coaches, or even peer groups serve the same role. They call out your blind spots. They keep you honest when you want to cheat your system. Bias thrives in secrecy. Journals you never review, rules you never enforce, routines you never track. These are breeding grounds for bias. Systems kill secrecy. They make everything visible, measurable, accountable. So ask yourself, where is your system weak? Do you trade without a written plan? Do you move stops without rules? Do you size by gut feel instead of formula? Each weak point is a door bias walks through. Close the doors with structure, and bias loses power. Bazerman and Moore leave us with this reality. Decision-making isn't about being perfect. It's about being protected. For traders, this isn't theory. It's survival. You will always feel bias. You will always feel stress. But if you've built a system that catches you, protects you, and guides you, you can survive long enough for your edge to play out. That's the difference between gamblers and professionals. Gamblers hope, professionals design. And in markets that punish hope, design is your only defense. Across these 10 parts, you've seen how Bazerman and Moore's insights from judgment and managerial decision-making map directly onto trading. Bias under stress distorts your reactions. Overconfidence convinces you that probability is certainty. Anchoring chains you to irrelevant numbers. Confirmation blinds you to disconfirming data. Escalation of commitment pushes you to double down when you should cut. Framing manipulates your perception of risk. Fairness bias distracts you with stories about what you're owed. Negotiation psychology reveals how every entry and exit is a bargain with the market. Feedback misinterpretation keeps you from learning what the market is teaching. And finally, system design arms you with the structures needed to resist all of these traps. The through line is clear. Your greatest enemy isn't the market, it's your own mind under pressure. And the greatest advantage you can build isn't predicting price, it's mastering bias with discipline and systems. Mark Douglas, Brett Steenbarger, Jared Tendler, Tom Hugard, they all echo the same truth. Bazerman and Moore proved in research. You can't delete bias, but you can design around it. Systems, routines, rules, and reviews aren't restrictions. They are weapons. They are shields. They are your edge. So here's your call to action. Stop hunting for the next indicator, write the next guru, the next secret strategy. Start building your own defense system. Write your rules. Automate your stops. Journal your emotions. Review your trades. Anchor your identity not in winning, but in discipline. Because when you master your own judgment, you no longer fear the market's chaos. You thrive in it. If this breakdown gave you value, make sure to like, comment, and subscribe. Share which bias hits you hardest. Let's build a community of traders who don't just chase markets, but master themselves. Overconfidence might be the single most dangerous mental trap you face as a trader. Bazerman and Moore dissect it thoroughly in Judgment in Managerial Decision-Making, showing how managers, leaders, and yes, market participants consistently overestimate their skills, knowledge, and ability to control outcomes. And if there's one place where overconfidence extracts its highest toll, it's in financial markets. Because the market doesn't care how smart you think you are. It doesn't care how many wins you've strung together. It only cares that when you get cocky, you leave yourself exposed. Think back to your own trades. How many times have you thought, this setup can't fail, only to watch the market rip the other way? That wasn't bad analysis. It was the illusion of control. You believed your chart, your system, your experience gave you power over uncertainty. But the brutal truth, you never had control. You had probability, and probability always comes with variance. Overconfidence tricks you into confusing probability with certainty, and that confusion destroys accounts. Bazerman and Moore show how managers routinely overestimate the accuracy of their forecasts. Translate that to trading. You predict price will rise 70% of the time, but you act as if it's 95%. That inflated confidence makes you size up too aggressively, widen stops, or ignore contrary evidence. Kahneman calls this the planning fallacy, believing you can predict and manage variables that are actually out of reach. For traders, the fallacy shows up when you think your edge is bigger than it is. Mark Douglas warned, you don't need to know what's going to happen next to make money. Yet overconfidence convinces you otherwise. You tell yourself, I see the future. I know this breakout will run. That's ego masquerading as insight. And ego in trading is a wrecking ball. Tom Hugard's Best Loser Wins drives this point home. The best traders aren't the boldest risk takers. They're the ones humble enough to admit they're wrong, fast. They cut losers because they don't pretend to control what they can't. Look at your last string of wins. Did you feel invincible? That's the danger zone. After success, overconfidence spikes. You assume you've cracked the code, that your skill alone explains the outcome. Bazerman calls this self-serving bias, crediting yourself for wins, blaming external noise for losses. In trading, it creates a vicious cycle. Your confidence rises after wins. You size bigger, you take sloppier setups, and when variance strikes, the crash is catastrophic. One hot streak, followed by one account-destroying trade. The illusion of control also explains why traders overtrade. You see more setups than really exist, convinced your sharp eye can spot edges everywhere. But as Knopfsinger showed in The Psychology of Investing, more trades don't equal more profits. They equal more exposure to noise. Overconfidence tells you the opposite. If I act more, I'll earn more. Reality punishes that illusion with churn, fees, and drawdowns. Ask yourself, how many times have you looked back at a week of overtrading and realized most of it was noise disguised as signal? Bazerman and Moore also emphasize calibration, how well confidence matches accuracy. In study after study, people are miscalibrated. They're far more certain than correct. For traders, miscalibration is deadly. You call yourself 90% confident in a trade, but your journal shows you're right only 55% of the time. That gap between belief and reality is the trap. The fix isn't to kill confidence, you need conviction to trade, but to calibrate it with data. Your trading journal isn't busy work, it's your calibration tool. Consider Jared Tendler's coaching. He teaches poker players and traders alike to track confidence against actual results. Confidence is earned, not declared, he says. That means after each trade, you record not just the result, but your confidence level going in. Over time, you'll see if your belief matches reality. That feedback loop cuts the illusion of control down to size. Without it, you're flying blind, believing your gut when your gut is just biased memory. Overconfidence is also linked to risk of ruin. Think about it. Ruin doesn't come from small, cautious trades. It comes from the oversized, ego-driven, I can't lose bets. The ones where you size 3x normal because you're sure. Bazerman shows how managers misjudge low-probability, high-impact events. Traders do the same when they dismiss tail risks. That crash won't happen now. This market can't reverse today. Then it does, and you're wiped. Risk managers call this underestimating correlation and volatility. Traders call it blowing up. So what's your defense? Humility, backed by systems. Mark Douglas would tell you, detach from outcome. Focus on executing your edge consistently, not proving you're right. Bazerman would add, test your calibration. Track confidence versus accuracy. Steenbarger would say, embrace adaptive learning. Use wins to reinforce discipline, not inflate ego. The trader who survives isn't the one who's most confident. It's the one who's most calibrated. The one who knows exactly how far their confidence can stretch before it breaks. Because here's the paradox. You need confidence to trade, but overconfidence kills you. Your job is to walk that razor's edge, to trust your system, but doubt your certainty, to act with conviction, but cut losses without hesitation, to know that control is an illusion, but risk management is real. Every time you size a position, you're answering one question. Am I sizing my edge or my ego? Bazerman and Moore warn you, if it's ego, the market will teach you humility the hard way. Don't wait for that lesson. Anchoring is one of those biases you think you understand, until it takes your money. Bazerman and Moore show how people anchor on the first number they hear, even when it's arbitrary. For traders, the anchor is almost never arbitrary. It's the last price, the breakout level, the analyst's target. And once that anchor lodges in your mind, it skews every decision you make. You think you're objective, but you're really negotiating with that anchor. In trading, that negotiation is often fatal. Think about your own charting. You see a stock that hit $200 last month, now trading at $150. Instantly, your mind says, it should go back. That's anchoring. The $200 mark becomes the true value in your head, even if fundamentals changed. Or imagine a breakout trader. Price pushes past $100, and that round number becomes sacred. Every pullback is now measured against that line, not against current context. Anchoring takes one reference point and makes it king, no matter how irrelevant it becomes. Anchoring also explains why traders hold losers. You bought Tesla at $250. Price drops to $220. But in your mind, $250 is fair value. You tell yourself, I'll hold until it gets back. That's anchoring, plain and simple. You're not reevaluating based on new data. You're stuck on the entry price. Bazerman calls this insufficient adjustment. You anchor, then fail to adjust enough, even when the evidence shifts. Mark Douglas would call it ego attachment. Your identity clings to the price you picked. The market doesn't care what you paid. Anchoring tricks you into thinking it does. Consider how anchoring shapes exits. A trader might plan to take profit at $180, but when price gets there, the anchor shifts. It could go higher. Anchoring isn't only about losses, it hijacks gains too. You adjust targets not based on logic, but on the new reference point. You raise the bar, you chase more, and often you give it all back. Anchoring doesn't just cost you on losers, it robs your winners too. Bazerman and Moore show experiments where even seasoned professionals anchor heavily, despite knowing the bias. Real estate agents asked to price a house gave estimates closer to whatever list price they were shown, even when told the number was random. If trained professionals can't resist, what chance do traders have staring at flashing numbers all day? Anchoring is hardwired, which means the only defense is awareness and structure. Trading under anchoring bias feels like tunnel vision. You see the chart through the lens of one number, blind to broader context. Brett Steenbarger emphasizes breaking that tunnel by widening your frame. Step back, zoom out, change time frames. Anchoring collapses perspective. Deliberate reframing restores it. That's why journaling trades with multiple reference points helps. Write down not just your entry, but your stop, your invalidation conditions, and the broader market context. When stress hits, those notes remind you the market is bigger than your anchor. Anchoring is also tied to the gambler's fallacy. You see 3 red candles, you anchor on that short-term pattern, and you convince yourself a green candle is due. That's not analysis. That's anchoring on the most recent streak. Bazerman's research shows how people overinterpret streaks in random events, and trading is full of streaks. The danger isn't in noticing them, it's in anchoring your decisions to them. So how do you break free? One tool. Pre-commit. Set stops and targets before entry, and don't move them without structured rules. If you set a stop at $140, moving it lower mid-trade isn't flexibility. It's anchoring to your entry. Another tool is external calibration. Use data, not memory. Your mind will anchor to the last dramatic move, but your journal shows the real distribution. If you track your setups, you'll see whether your target is realistic, whether your stop placement makes sense, whether your gut is anchored to a false number. Jared Tendler would tell you, until you externalize those anchors, you'll keep trading the ghosts in your head instead of the numbers on your chart. Anchoring bias is sneaky because it feels rational. You tell yourself, I'm just waiting for fair value. But fair value isn't fixed, it changes every tick. Anchoring blinds you to that. It makes you fight the market's reality with your own mental snapshot. And when reality wins, it drains your account. Remember this. Every number on your screen is a potential anchor. Entry price, analyst forecast, 52-week high. They all fight for space in your mind. Bazerman and Moore prove you can't avoid anchoring. It's automatic, but you can predict where it will hit and build defenses. Write your plan before you trade. Track your adjustments. Ask yourself mid-trade, am I trading the chart or my anchor? Because if it's the anchor, you're not trading the market. You're trading your memory of it. The market doesn't care what you paid, where you anchored, or what you hoped for. It only cares where price is moving now. Anchoring is a bias you can't delete, but you can outsmart it. The first price will always stick, but you decide whether it controls you. If you want to survive, treat every anchor like quicksand. Recognize it fast, step aside, and ground yourself in rules, data, and discipline. That's how you turn anchoring from an invisible chain into a visible warning sign. And every time you break free from it, you reclaim a piece of your objectivity, the one edge most traders never master. Confirmation bias is the silent killer of trading accounts. Bazerman and Moore explain how people selectively search for, interpret, and remember information that confirms their pre-existing beliefs. For traders, this is lethal because once you take a position, your brain starts working overtime to prove you were right. Instead of analyzing, you're justifying. Instead of observing, you're defending. And the market punishes that blindness with ruthless efficiency. You've seen this in action. You go long on a stock at $150. It dips to $145. Instead of asking, is my thesis invalidated? You go hunting for reasons it will bounce. You find a bullish article, a tweet from an influencer, a line on a chart. Every scrap of evidence becomes fuel for your conviction. That's not analysis. It's confirmation bias at work. And it grows stronger the deeper you're in the trade. The more capital you commit, the more your mind scrambles to protect your ego from the pain of being wrong. Confirmation bias also infects your social inputs. You scroll Twitter and cherry-pick only the analysts who agree with you. You mute or ignore those who don't. Suddenly your feed looks like a mirror, reflecting your conviction back at you. Bazerman's research shows managers do the same. They hire, listen, and promote voices that reinforce their worldview. Traders fall into the same trap, creating echo chambers that shield them from reality. In a market built on uncertainty, that shield becomes a coffin. A dangerous twist is hindsight confirmation. After a loss, you retroactively frame the data to fit your bias. The setup was right, the market was wrong. That false narrative keeps you from learning. Bazerman warns that bias isn't just in how we predict, but in how we explain. If every loss is bad luck and every win is skill, you never grow. The market becomes your scapegoat instead of your teacher. Bazerman and Moore show how confirmation bias blinds even when evidence is overwhelming. In experiments, participants clung to their beliefs despite clear contradictory data. For traders, this means you can watch your stop get hit and still mutter, "But I was right." That mindset is poison. Mark Douglas warned, "You can be right in your analysis and still lose money." The point isn't to prove you're right, it's to follow your plan, manage your risk, and stay alive. Confirmation bias flips that priority on its head. One of the most dangerous forms is pattern confirmation. You think you see a head and shoulders, then suddenly every line you draw, every time frame you check, reinforces that pattern. You ignore the failed breakouts, the volume divergence, the conflicting signals. You've convinced yourself the market is showing you what you want to see. But as Michael Shermer reminds in The Mind of the Market, humans are pattern-seeking machines, even when no pattern exists. Confirmation bias weaponizes that instinct against you. Here's the question. How many trades have you held longer than you should, just because you didn't want to admit your bias? That's confirmation in action. And it costs more than money. It costs time, emotional energy, and opportunity. While you cling to one trade, better ones pass by. While you argue with the market, other traders quietly follow their plan and move on. So what do? First, expose yourself to disconfirming evidence. Bazerman calls this considering the opposite. Force yourself to seek reasons your trade could fail. Write them down before you enter. Second, separate your thesis from your identity. You are not your trade. If the market proves your thesis wrong, that's data, not a personal attack. Third, build routines that challenge your bias. Review losing trades with brutal honesty. Ask, what did I ignore? What data was I blind to? Jared Tendler suggests a similar exercise. Write down the emotional driver behind your confirmation. I want this trade to work because I need to recover. Naming the motive cuts its power. Steenbarger adds another strategy. Invite feedback from peers who aren't afraid to challenge you. It hurts to hear you're biased, but that sting can save you from disaster. The truth is, no one escapes confirmation bias, but the best traders build communities, routines, and habits that keep it in check. Confirmation bias is dangerous because it feels like conviction. You tell yourself you're being disciplined, that you're sticking to your plan. But discipline without flexibility is just stubbornness in disguise. Remember, the goal is not to be right, it's to make money. Bazerman and Moore prove that clinging to confirmation is the fastest way to blind yourself. The market doesn't care about your opinion. It doesn't care about your chart drawings. It doesn't care about your conviction. It only cares about price, liquidity, and order flow. Every time you filter data to confirm your view, you're putting your ego above survival. And in trading, ego always loses. So here's your challenge. Next time you're in a trade, ask yourself, what evidence would prove me wrong? If you can't answer, or worse, if your answer keeps shifting, you're trapped in confirmation bias. And until you break free, you're not trading the market. You're trading your ego. Confirmation bias is a mental trap you can't delete, but you can outsmart it. You do that by inviting contradiction, by journaling your thought process, by forcing yourself to see both sides. You remind yourself that the market is bigger than your opinion, faster than your bias, and colder than your ego. And the trader who learns to cut through confirmation doesn't just survive, he thrives. Because when you stop needing to be right, you finally put yourself in position to get paid. Escalation of commitment is the trap that turns small mistakes into career-ending disasters. Bazerman and Moore describe it as the tendency to keep investing in a failing decision because you've already sunk resources into it. Traders call it revenge trading, averaging down, or doubling up to get back. Whatever the name, the psychology is the same. You don't want to admit you were wrong, so you throw more money at the problem, and the market eats you alive. You felt this. You take a trade at $100, it drops to $95, and instead of cutting, you add more. You tell yourself, I'm lowering my average. When it bounces, I'll be whole again. That isn't strategy, it's escalation. You've let loss dictate your next move. You're no longer trading your system, you're trading your emotions. And as Bazerman and Moore show, escalation under pressure almost always ends in deeper losses, not redemption. This is the sunk cost fallacy in action. Rationally, past costs are gone. They shouldn't affect your next move. But psychologically, they do. Bazerman and Moore explain how managers in failing projects justify throwing more resources into them. We've already invested so much, we can't stop now. Traders echo the same. I've already lost half my position. I can't quit here. But you can, and you must. Otherwise, you're not trading. You're gambling with borrowed hope. Escalation of commitment is particularly dangerous in trading because of leverage. One bad escalation in a leveraged position can erase months or years of gains. You've seen the horror stories, traders doubling down until a margin call wipes them out. They didn't blow up because of one bad entry. They blew up because they escalated instead of exiting. Mark Douglas warned against this trap. Cut your losses quickly, without reservation. Yet traders hesitate because cutting means admitting they were wrong. Escalation of commitment is ego's last stand. It whispers, if you just hold on, you'll be redeemed. But the market doesn't redeem, it only reflects. And if you're holding a loser, the reflection is pain. Bazerman and Moore show how escalation is fueled by accountability pressures. Managers who don't want to look bad in front of bosses double down to prove themselves. For traders, the audience is your own self-image. You don't want to admit to yourself, or worse, your journal, that you failed. So you fight the trade. But every fight with the market is one you lose. Brett Steenbarger says the best traders redefine failure. They don't see cutting a loser as being wrong. They see it as being disciplined. That reframing kills escalation before it starts. If you believe exiting early is victory, not defeat, your ego no longer fuels the trap. Escalation also shows up in scalping and day trading. You miss one setup, so you chase another with bigger size. You get stopped, so you immediately re-enter, desperate to make it back. In Bazerman's language, you're escalating commitment to your emotional state, not your plan. Each new entry isn't a trade, it's a plea for relief, and the market punishes pleas. Jared Tendler calls this the tilt phenomenon. In poker, tilt is when emotions override logic and you chase losses recklessly. Traders tilt too. After a bad beat, you double size, take impulsive setups, or abandon your rules. It's the same psychology Bazerman describes, throwing good resources after bad, hoping to erase the mistake. Tilt is dangerous not because of one trade, but because it spirals. One mistake compounds into a session-ending bloodbath. So how do you stop it? First, embrace pre-commitment. Decide your stop before you enter. Automate it if you can. Bazerman's research shows that pre-commitments reduce escalation because they remove decision-making in the heat of loss. Second, shift your identity. If your self-worth is tied to being right, escalation will always lure you. But if your identity is tied to being disciplined, then cutting losses reinforces your ego instead of threatening it. Tom Hugard says the best traders pride themselves on losing well. That's not weakness, it's mastery. Every quick exit is a small victory over escalation. Third, use structured journaling. Track not only your trades, but your emotions after a loss. Do you feel the urge to double down, to chase, to fight back? Naming those urges weakens them. Over time, you'll spot escalation forming before it hijacks you. Steenbarger emphasizes rehearsing responses. Visualize yourself cutting a loser and walking away. When the moment comes, you've already practiced the discipline. Escalation of commitment is seductive because it feels like persistence. I'm not giving up, you tell yourself. But trading isn't about persistence, it's about probabilities. The market doesn't reward stubbornness, it rewards adaptability. Bazerman and Moore's research proves that doubling down on a bad decision almost always increases the eventual loss. In trading, that loss isn't theoretical, it's your capital, your career, your future. So ask yourself, how many times have you tried to rescue a trade only to watch it sink deeper? How many times have you risked ruin because you didn't want to take a small loss? Each time, escalation was the enemy. And each time you cut instead of escalate, you win. Not against the market, but against your own destructive instinct. The market doesn't care how much you've already lost. It doesn't care how badly you want to make it back. Escalation is a one-way street to ruin. The only way off is discipline. Cut early, cut clean, and cut often. Because every time you escalate, you're not proving resilience, you're proving bias. And every time you cut, you're proving mastery. Which kind of trader do you want to be? Framing is the invisible lens that shapes your choices. Bazerman and Moore highlight how the way a problem is presented, gain or loss, risk or safety, alters decisions dramatically. For traders, framing is everywhere. How you view a red candle, how you interpret a headline, how your broker displays P&L. You think you're rational, but in reality, your brain reacts differently depending on the frame. And those reactions can be the difference between steady growth and reckless ruin. Consider this example. You enter a trade with $1,000 risk. If framed as "I could lose $1,000, you hesitate, maybe skip the setup. But if framed as "I'm risking 1% to make 3%, you take it confidently. Same trade, same math, different frame. Bazerman and Moore proved that the way outcomes are presented shifts behavior more than the actual probabilities. Traders fall into this daily. You hesitate, chase, or freeze, not because the numbers changed, but because the frame did. Framing doesn't just influence risk-taking, it also shapes patience. If you frame a winner as house money, you might gamble it away, telling yourself it isn't really yours. Casinos exploit this psychology, so do markets. After a strong morning, you might trade too aggressively in the afternoon because you frame those gains as expendable. But if you framed them as part of your year-end equity curve, you'd guard them carefully. Same money, different frame, different outcome. Bazerman and Moore show that people are far more risk-averse when choices are framed as gains and far more risk-seeking when framed as losses. Traders live this daily. When you're up, you cut winners early to lock in gains. When you're down, you hold losers too long, hoping to get back. It's not strategy, it's framing bias. Kahneman and Tversky proved it with the famous Asian disease experiment. Traders prove it every day in their P&Ls. Mark Douglas warned against this subtle trap. The market is neutral. It moves up, down, and sideways. It's the trader who makes it positive or negative. That's framing in a nutshell. The market doesn't frame itself, you do. And the way you frame it dictates how you feel, how you act, and ultimately, how you perform. Brett Steenbarger suggests reframing through process focus. Instead of framing a stop out as a loss, frame it as a cost of doing business. Instead of framing a missed setup as failure, frame it as evidence that your rules kept you safe. Reframing shifts emotion from fear to learning. And that shift is everything. Because fear kills execution, but learning sharpens it. Framing also explains why traders freeze. When price nears your stop, do you frame it as disaster or feedback? If you frame it as disaster, you panic, widen the stop, and escalate commitment. If you frame it as feedback, you accept the signal and exit clean. Same event, different frame, opposite behavior. The illusion of certainty is another framing trick. Analysts frame predictions with confident language. This stock will double. That framing seduces you into forgetting probabilities. Bazerman's research shows that certainty framing leads to overcommitment, while probability framing fosters caution. For traders, this means you must train yourself to translate bold headlines into probabilities, not promises. So how do you fight framing bias? First, recognize it's everywhere. Every chart, every P&L report, every headline is a frame. Second, deliberately reframe. If your trade is down $200, don't frame it as losing $200. Frame it as spending $200 to learn what doesn't work. That doesn't make the money return, but it changes your mindset from fear to growth. Third, track your frames in a journal. After each trade, ask, how did I frame this? Did that frame help or hurt? Awareness is the lever that breaks framing bias. Framing bias also interacts with risk management. If you frame risk as what I could lose, you'll avoid trades and miss edges. If you frame risk as the cost of doing business, you'll size rationally and stay consistent. Bazerman and Moore prove that reframing shifts decisions dramatically. For traders, reframing can mean the difference between paralyzed hesitation and confident execution. Here's the wake-up call. Every trade you take is a framing experiment. Do you frame it as life or death, or one of 1,000 edges across a career? If it's life or death, you'll choke. If it's just one edge, you'll act calmly. And over time, calm execution compounds into success. The market doesn't care about your frames. It doesn't care if you call a stop-out disaster or tuition. But your brain does. Framing is the invisible hand guiding your choices. Master it, and you master your reactions. Ignore it, and you'll keep sabotaging yourself with the stories you tell. Bazerman and Moore warn you, the frame is often more powerful than the fact. In trading, that power can mean the thin line between ruin and resilience. Fairness might seem like an odd word in trading. After all, markets aren't designed to be fair. They're designed to be efficient. But Bazerman and Moore devote entire chapters to how perceptions of fairness and ethics shape decisions. And for traders, fairness isn't about how the market treats you, it's about how you treat your own process. Because when you let your sense of fairness dictate your trades, discipline breaks and bias takes over. Think about loss recovery. You lose $500 in the morning. You tell yourself, it's not fair, I need to get it back. That mindset drives you into reckless trades. Or you see another trader post massive gains on Twitter, and you mutter, it's not fair I missed that move. Suddenly you're chasing a random setup out of envy. In both cases, fairness bias hijacks discipline. You stop trading probabilities and start trading emotions. And emotions, as you know, don't pay. Bazerman and Moore show that fairness norms dominate even when they're irrational. People will reject profitable deals if they feel unfair. In markets, traders sabotage themselves with the same instinct. You cut a trade early because it's not fair that it reversed on me. Or you move a stop because it's not fair the market spiked against me. But fairness is irrelevant. The market isn't your parent, your teacher, or your judge. It's just a weighing machine of supply and demand. Your job isn't to argue with it. It's to align with it. Ethics also play a hidden role. Bazerman emphasizes that unethical shortcuts often backfire in the long run because they erode trust and discipline. For traders, ethics isn't about insider trading. It's about honesty with yourself. Are you logging trades accurately? Are you hiding mistakes in your journal? Are you pretending you followed your rules when you didn't? Every lie you tell yourself is a fracture in your discipline, and fractures under stress turn into collapses. Mark Douglas insisted, the market is never wrong, only your interpretation is. Apply that to fairness. The market doesn't owe you symmetry, justice, or redemption. If your stop gets hit by a single tick and price then rockets in your direction, that's not unfair. It's reality. If you chase because you deserve to be in, you're violating discipline. And if you cut a winner early because it's only fair to take what I can, you're sabotaging your edge. Discipline, then, is fairness applied inward. You treat every trade by the same rules. No favorites, no exceptions. That's fairness in trading, not expecting the market to be fair to you, but forcing yourself to be fair to your system. Brett Steenbarger calls this consistency of process. When you enforce fairness on yourself, you build trust in your rules. And when you trust your rules, you no longer need the market to feel fair. You're anchored in discipline, not in justice. Fairness bias also explains revenge trading. You feel wronged by the market, so you demand payback. That's fairness thinking disguised as discipline. But revenge trades aren't about edges, they're about ego. And ego-driven trades usually end in larger losses. Tom Haugard reminds us, the market doesn't care about your feelings, it only cares about your risk. Jared Tendler connects fairness bias to entitlement tilt. When traders feel the market owes them, they tilt harder. The fix? Radical acceptance. The market owes you nothing, not even an explanation. Accepting that truth frees you from chasing fairness and anchors you in reality. The only fairness you control is your discipline, executing your system equally across wins and losses. So here's the challenge. Audit your fairness expectations. Where are you demanding fairness from the market instead of yourself? Do you demand the market reward your analysis? Do you demand a fair shot after every loss? Each demand is a trap. Replace them with one demand only, fairness to your rules. Hold yourself accountable to consistent execution and stop asking the market to play fair. Because here's the truth. Fairness is a story you tell yourself. The market doesn't play by your story. It doesn't care about your expectations. Bazerman and Moore remind us that fairness judgments feel real, but often distort rational choice. For traders, clinging to fairness is just another bias. Drop it, and you free yourself to focus on discipline. And discipline, not fairness, is what keeps you alive in markets that owe you nothing. Negotiation might seem far removed from trading. You picture executives at a table, bargaining terms. But Bazerman and Moore show that negotiation is really decision-making under conflict and uncertainty. And isn't that what every trade is? You and the market negotiating price. You place an order, the market responds. Every fill, every entry, every exit is a negotiation between your conviction and the crowd's liquidity, which means negotiation psychology matters more than you think. Bazerman outlines negotiation biases: anchoring, overconfidence, escalation, framing. Traders face the same distortions, only faster. When you hit buy or sell, you're entering a contract with risk. The price is your negotiation line, your stop loss is your exit clause, and your size is the leverage on the deal. If you ignore these, you're negotiating blind. In trading, the other side isn't a single counterparty, it's the aggregate of all participants. But the principles remain. If you enter without preparation, without clarity, you'll be exploited by volatility, spreads, and slippage. If you approach entries with patience, you negotiate better. Think of limit orders versus market orders. A market order is like walking into a bazaar and shouting, "I'll pay anything." A limit order is walking in with a firm price. Which side do you think wins more often? Bazerman and Moore stress the importance of BATNA, the best alternative to a negotiated agreement. For traders, BATNA is your next setup. If you believe this is the only trade, you negotiate poorly, overpay, over-risk. But if you know another opportunity will come, you negotiate with strength. That's why pros preach abundance mindset. There's always another trade. Scarcity mindset, I can't miss this, leads to desperate bargains with the market. Negotiation research also shows how time pressure skews decisions. Traders feel this constantly. A breakout candle forms, you panic, you hit buy at the top. That's poor negotiation. You let time pressure force bad terms. Skilled traders wait for confirmation, for retrace, for liquidity to come to them. They negotiate with patience, not desperation. Anchoring plays a role here too. Just as negotiators anchor with high first offers, traders anchor on first prints. The opening price, the breakout level, the analyst target, these become anchors that skew your sense of value. Smart negotiators use anchors strategically. Smart traders recognize them and don't let them dictate terms. Bazerman and Moore emphasize integrative negotiation, finding win-win solutions instead of zero-sum battles. For traders, integrative negotiation means aligning with market structure. Instead of forcing a trade, you find entries where your needs align with liquidity. Brett Steenbarger says the best traders listen to the market's negotiation cues: order flow, volume, momentum. They don't impose, they collaborate. That mindset keeps you flexible and adaptive. Consider also the role of preparation. Negotiators who prepare options, data, and alternatives outperform those who wing it. Traders who pre-plan scenarios, backtest entries, and rehearse risk plans outperform those who feel it out. Your prep is your negotiation leverage. Walk into a negotiation unprepared, you lose. Walk into a trade unprepared, you bleed. Jared Tendler would frame this as managing emotional leverage. If you enter negotiations tilted, you overpay. If you enter trades tilted, you over-risk. Emotional state is part of the bargain, which means your pre-trade routine isn't optional. It's your negotiation prep. Calm mind, clear plan, measured risk. That's how you negotiate with markets that are designed to test your limits. Another critical lesson: knowing when to walk away. Great negotiators don't chase bad deals. Great traders don't chase bad setups. Your ability to pass on weak trades is the trader's version of walking away from a bad contract. It's not weakness, it's power. Because walking away preserves your capital, your time, and your discipline. So ask yourself, do you negotiate like a disciplined professional or like a desperate gambler? Do you prepare your terms or do you let the market dictate them? Do you accept slippage as fate or do you plan for it as part of the bargain? Every trade is a negotiation, and the side with clearer terms, stronger discipline, and calmer psychology almost always wins. Bazerman and Moore's research makes one truth clear: negotiation isn't about dominating, it's about structuring choices under conflict. And that's all trading is. Structuring your choices under pressure, with money at stake. The trader who sees every trade as a negotiation gains clarity. The trader who doesn't bleeds. Trading is negotiation under uncertainty. And the better you negotiate, anchoring wisely, managing time pressure, preparing with clarity, and walking away when needed, the more consistently you'll win the only negotiation that matters, the one with yourself. Because in trading, your real counterparty isn't the market, it's your own impatience. Feedback is the lifeblood of growth, but only if you interpret it correctly. Bazerman and Moore emphasize how people misread outcomes, taking success as proof of skill and failure as bad luck. For traders, this distortion is everywhere. Every win feels like validation. Every loss feels like injustice. But unless you analyze feedback honestly, you'll repeat mistakes and miss lessons the market is screaming to teach you. Think about your last big winner. Did you immediately assume it was your analysis, your skill, your insight? Or did you ask, how much of that was variance? How much was edge? That distinction matters. If you take credit for variance, you'll oversize and overtrade. If you blame bad luck for every loser, you'll never improve your system. Feedback without honesty isn't feedback, it's ego. Bazerman and Moore show how managers misattribute outcomes to skill, ignoring randomness. Traders fall into the same trap. You get 5 wins in a row and assume your edge has improved. Maybe it has, but maybe it's just variance. Without structured feedback, you won't know. That's why journals, stats, and reviews matter. They separate luck from edge. They turn random streaks into measurable lessons. Feedback is also poisoned by hindsight bias. After the fact, you convince yourself you knew it all along. That's not memory, it's rewriting history. You forget your doubts, your hesitation, your lack of clarity, and you record a fantasy version of the trade. That distorted feedback feeds overconfidence. Bazerman's research proves people are terrible at recalling uncertainty after outcomes. If you don't journal in real time, your feedback loop is a lie. Jared Tendler calls this results-oriented thinking. In poker and trading alike, it's toxic. You size up on the next hand because the last one worked, even if the decision quality was poor. You size down after a loser, even if the setup was textbook. You're letting outcomes, not process, dictate your learning. Bazerman warns, feedback misread through bias doesn't teach, it deceives. Mark Douglas flips this on its head. Judge yourself not by wins or losses, but by how faithfully you executed your plan. That's how you break the cycle. If you followed your edge and lost, that's a win in discipline. If you broke rules and profited, that's a failure in process. This is the feedback framework that builds real growth. The market's outcomes are random in the short run, but your execution is always in your control. Feedback is also about emotional calibration. Brett Steenbarger says, traders who journal emotions alongside trades learn faster. Why? Because they see the link between state and outcome. A setup taken in calm focus plays out differently than the same setup taken in tilt. Bazerman would agree. The quality of decision-making context matters as much as the decision itself. Ignoring that context means ignoring half the feedback. So how do you sharpen feedback? First, collect it systematically. Journal every trade, entry, exit, size, reasoning, emotional state, and confidence level. Second, interpret it with humility. Assume randomness plays a role in every outcome. If your strategy has a 55% win rate, expect 45% losers. A string of losses doesn't mean the edge is gone. It means variance is alive. Bazerman's research shows most decision makers underweight randomness. Don't be that trader. Respect variance. Expect streaks. Learn from patterns that persist beyond noise. Third, review with structure. Weekly, monthly, quarterly reviews separate short-term noise from long-term signal. Did you follow your plan 80% of the time this month? Did your strategy perform in line with backtests? Did your emotions correlate with mistakes? These structured reviews cut through illusions. They keep you anchored in reality instead of storytelling. Feedback misinterpretation also drives emotional spirals. One lucky win makes you euphoric, so you overtrade. One unlucky loss makes you despondent, so you hesitate. Both reactions stem from poor feedback processing. The fix? Anchor yourself in process metrics. Did I follow my rules? Did I size correctly? Did I journal? If yes, the trade was a success, regardless of P&L. If no, it was failure, regardless of profit. That's how you rewire your brain to learn properly. Bazerman and Moore's warning is stark. Without accurate feedback, decision makers entrench errors. Traders without accurate feedback do worse. They accelerate destruction. Because the market punishes repeated mistakes brutally. The trader who learns to interpret feedback without bias builds an adaptive edge. You grow not because the market is kind, but because you extract truth from it. And in a game where truth is buried under noise, that skill is priceless. Fail to build it, and you'll spin forever in cycles of illusion, celebrating wins you didn't earn, repeating losses you could have avoided.